So in the last video, we met the two shelters, USD JPY and USD CHF, the pairs the world runs to when it gets scared. Today, we go to the complete opposite end of the market, because the three currencies we're about to meet don't care all that much about fear. They care about stuff, real physical stuff you can weigh and load onto a ship. Barrels of crude oil, tons of iron ore, and, I'm not joking, powdered milk. These are the commodity dollars, and once you see what's behind them, they stop looking like currencies and start looking like receipts for what a country sells. They're the Canadian dollar, the Australian dollar, and the New Zealand dollar, the Loonie, the Aussie, and the Kiwi. By the end of this video, you'll know what actually makes a currency a commodity currency, what drives each of these three day to day, and why the Aussie and the Kiwi being near twins is a genuine danger to your account. There's also a reading trap waiting for you in here, because for the first time in this series, the dollar is going to sit on both sides of the price in the same lesson. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. So let's start with the label itself, because it explains almost everything that follows. A commodity currency belongs to a country that makes most of its money selling raw materials to the rest of the world. Not software, not luxury goods, not financial services. Raw material. Rocks, energy, food. And here's the link that matters to you. When the world wants a lot of what that country digs up or grows, buyers have to get hold of that country's currency to pay for it. Demand for the export becomes demand for the money. So the currency ends up partly tracking the price of the thing it sells. There are 3 of them among our 7 majors, and traders almost never use their full names. The Canadian dollar is the Loonie, named after the loon, the bird stamped on the $1 coin. The Australian dollar is simply the Aussie, and the New Zealand dollar is the Kiwi, again after a bird on a coin, not the fruit. Together, you'll hear them called the Comdolls. Learn the nicknames now, because when you start reading market commentary, nobody is going to spell them out for you. Now, the trap, and this is the one thing I really want you to carry out of the first half of this video. These 3 don't line up the same way. Canada is quoted as USD/CAD, dollar on the left, exactly like the pairs we did last time. But Australia and New Zealand are quoted the other way around, as AUD/USD and NZD/USD, with the dollar on the right. So inside this single lesson, the dollar changes sides, which means on USD/CAD, a rising chart is a stronger dollar. On AUD/USD, a rising chart is a stronger Aussie. Same dollar, opposite readings. And no, there's no clever economics behind that. It's convention, old market habit, inherited in part from the days when these currencies were priced against the British pound. It's also why you should get used to writing it as NZD/USD and never USD/NZD. You don't get to argue with the convention. You just have to check which side the dollar is standing on before you form an opinion about a chart, every single time. All right, let's take them one at a time, starting with Canada. Canada is an energy economy. Crude oil is its single largest export by value, and the overwhelming majority of it goes to one customer, the United States, right next door. So the Canadian economy is bolted to 2 things, the price of oil and the health of the American economy. Hold on to both of those, because both of them show up on the USD CAD chart. Here's the mechanism, and it's simpler than people expect. When oil prices rise, Canada earns more for every barrel it ships out. More money flows into the country, the outlook improves, and buyers need Canadian dollars to pay for that oil in the first place. The loonie tends to strengthen. And because Canada is quoted with the dollar on the left, a stronger loonie pushes the pair down. So the rough rule is this: oil up, USD CAD down. They tend to sit on opposite ends of a seesaw. But, and I say some version of this every time, for a reason, that's a tendency, not a law. There are 2 currencies in USD CAD, and the dollar has opinions of its own. If the Federal Reserve is aggressively raising rates while oil is also climbing, the dollar can simply overpower the oil story and drag the pair higher anyway. So don't treat crude as a signal. Treat it as context, one voice in the room, not the whole conversation. Personality-wise, USD CAD is the mildest of the three. It's liquid, its spread is tight, and it spends a lot of its life ranging rather than trending, partly because Canada and the United States are so economically intertwined that the two currencies rarely sprint away from each other for long. And here's the quirk that catches people out. American data often moves USD CAD more than Canadian data does. You're trading a pair where one country's news dominates both sides of it. Now Australia, and this is a completely different animal. Australia is a mining economy. Iron ore, the raw material for steel, is its biggest export, alongside coal, natural gas, and gold. And the buyer that matters most, by an enormous margin, is China. So where Canada's fortunes are tied to the neighbor next door, Australia's are tied to a country on the other side of an ocean. That connection makes the Aussie genuinely useful as a tool. It's a live barometer of global growth, and of China in particular. When Chinese factories are busy, they need steel, so they need iron ore, so they buy Australian. Which is why a weak Chinese manufacturing number released in the morning can throw the Aussie around more than anything Australia itself publishes that same week. You can be an expert on Australia and still get blindsided. And that leads straight into the Aussie's real identity. Remember risk on and risk off from last video? If the yen is where money hides, the Aussie is where money goes when it stops hiding. It's the classic risk on currency. Confidence returns, growth looks good, stock markets rally, and the Aussie usually rises with them. Fear shows up, and the Aussie is often one of the first things sold. It is, in almost every sense, the yen's opposite number. There's a historical reason that pairing runs so deep. For long stretches, Australia paid noticeably higher interest rates than Japan did, and traders exploited that gap directly. Borrow cheaply in yen, convert, and hold Aussie to pocket the difference. That's called the carry trade, and it's why AUD-JPY became the market's unofficial fear gauge. While confidence is high, the carry trade builds, and that chart grinds upward. When fear arrives, everyone unwinds at the same moment, and it falls like a stone. Which brings us to New Zealand. And I'll be honest, this one surprises people. New Zealand's biggest export isn't a metal or a fuel. It's dairy. Milk powder, butter, cheese, shipped mostly into Asia. Add meat and timber, and you've got the picture. It's a small economy selling food to a very large continent, and the Kiwi is the smallest and least traded of our 7 majors. So the Kiwi has the same DNA as the Aussie. Commodity-driven, growth-sensitive, plugged into Asian demand, but in a much thinner package. Less volume means a wider spread, and it means the moves can be sharper and less orderly. The Kiwi will jump where the Aussie merely leans. For a beginner, that's the warning worth writing down. Same story, less forgiving execution. And here's where those two become a real risk to your account. The Aussie and the Kiwi move together a lot. Same region, same buyers, same sensitivity to global mood. So if you buy AUD USD and then buy NZD USD because you spotted 2 nice-looking setups, you have not opened 2 trades. You've opened 1 trade in double size. That's the same trap we flagged with Euro USD and USD CHF last time, and we'll take the whole subject apart in the chapter on correlation. There's a timing side to these 3 as well, and you'll appreciate it later. The Aussie and the Kiwi do most of their real work during the Asian session, when their own countries and their biggest customers are awake. USD CAD is the opposite. It comes alive in the New York session, when Canada and the United States are both at their desks. Trade the Kiwi at the wrong hour, and you'll sit there staring at a flat chart, wondering what you did wrong. We'll build the full clock in the chapter on sessions. So, should a beginner trade the Comdolls? My honest take, not as your first pair, but they make an excellent second lesson. USD CAD is reasonable and well-behaved, once you accept that it ranges more than it trends. USD is genuinely instructive because it forces you to look outside your own chart at what the rest of the world is doing. The Kiwi, I'd leave for later. There's no reward for choosing the thinner version of a story you can already trade in the deeper one. And now the usual line in the sand. Knowing that the Loonie follows oil doesn't tell you where to buy it. Levels, structure, and timing all belong to our technical analysis course. And that urge to jump into the Aussie the second you see a commodity headline, with no plan and no size discipline, that one isn't about the market at all. That belongs to our trading psychology course. Here, we're only building the map. Here's something to do the moment this video ends. Open USD/CAD, Put a crude oil chart right underneath it. Scroll back a few months and watch how often they lean in opposite directions. And notice the stretches where they don't. Then put AUD USD and NZD USD side by side and see how similar those two charts really look. Finally, compare the spread on NZD USD to the spread on Euro USD. 3 minutes of that will make this entire lesson permanent. So let's bring it home and answer the question we opened with. What are the commodity dollars? They're the Canadian dollar, the Australian dollar, and the New Zealand dollar. The currencies of 3 countries that make their living selling raw materials, so each one partly tracks the price of what it sells. Oil for the Loonie, metals and Chinese demand for the Aussie, food and the world's appetite for risk for the Kiwi. They're not random charts, they're the price of a country's shopping list. And with that, you've now met all 7 majors: the patient teacher, the fast athlete, the 2 shelters, and these 3 that follow the price of things. In the next video, we add one more chart that behaves like a currency, but technically isn't one: gold. Why does XAU USD sit right there beside the majors on every platform? Why does the entire market watch it? And is gold actually a currency at all? That's next. I'll see you there, trader. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Comlucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Comlucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.